Same portfolio, different taxes. Put the wrong investments in the wrong accounts, and you may end up tipping the IRS 5 figures over time. Today, I'm going to show you exactly what belongs in taxable brokerage accounts, what belongs in Roth, and what belongs in your traditional or pre-tax accounts. By the end, you should have a simple checklist in your head about where each investment goes. And as always, this is for educational purposes only and not financial advice. Let's start with a 10-second framework. Taxable brokerage likes tax-efficient investments that you can hold for the long term. Roth, you want to treat more like a vault. Save space for your highest growth or more tax-inefficient big winners. Traditional or pre-tax accounts are like the garage for ordinary income-spitting assets like most bonds. Think of moving day. Messy, heavy gear in the garage, priceless art in the vault, and clean, low-maintenance pieces in the living room. Now, let's talk about what actually goes well in a normal taxable brokerage account. Your best friends here are going to be your broad market stock index ETFs. Think total US, total international, S&P 500. They're low turnover and most of the dividends are qualified. And if you hold those for more than a year, your gains are going to be long-term capital gains, so you'll typically pay less in taxes. If you park international stock ETFs in taxable, you can often claim a foreign tax credit on your return, something you don't get inside of IRAs. If you need fixed income in taxable, treasuries and treasury funds are solid because the interest is generally exempt from state income tax, which matters if you live in a high-tax state. If you're in a higher tax bracket, municipal bond funds can also work since the interest is actually federally tax-free, and in-state munis may also be state tax-free. Individual stocks that you plan to hold for a long time also fit nicely in taxable accounts because it lets you harvest losses during down markets and donate appreciated shares later for a double win. So what do I try to keep out of taxable? Generally, real estate investment trusts. These funds often pay non-qualified dividends that get taxed like ordinary income. So I would usually avoid those. High turnover active funds tend to throw off capital gain distributions each year. And high yield bond funds spit out ordinary income. Many commodity products and K1 structures can be quirky at tax time, so you'll want to avoid those as well. And short-term trading is basically volunteering for ordinary income tax rates. Inside taxable, you want to be thoughtful with tax loss harvesting and avoid wash sale rules. You'll also want to give to charity in these accounts. Consider donating appreciated shares instead of cash. Next up is the Roth, which I would treat like a vault. This space is precious. I prioritize the highest expected return assets, your core equity exposure, and any tilts you truly believe in, like small cap or value. Roth is also a great home for tax inefficient but strong returning investments such as REITs or index funds, because all of the growth and the distributions are tax-free when the rules are met. The big idea is simple. You want your fastest growers compounding in one place that you will never have to share with the IRS. For the traditional pre-tax space, think your 401k or traditional IRA, this is where I'm happy to park things that generate ordinary income. So core bond funds might belong here, TIPS belong here. If you're going to hold higher yield bonds or more active strategies that throw off income, they're probably a better fit here than in taxable. You're deferring the annual tax hit today and you'll manage withdrawals later on your terms. If your Roth is full, REITs can live in pre-tax as well, still far better than parking them in taxable. If you're HSA eligible, the HSA is a triple tax advantage unicorn, so contributions can be pre-tax, growth is tax-free, and qualified withdrawals for medical expenses are tax-free as well. I often treat the HSA like a stealth Roth for healthcare. Invest it, let it grow, and pay out of pocket for current expenses if you can. Save the receipts and reimburse yourself later tax-free. After age 65, non-medical withdrawals are simply taxed like a traditional IRA would be, and there's no penalty. Some quick cautions and state-specific notes you may want to watch out for. States like California, capital gains are taxed as ordinary income at the state level there. So that sweet federal long-term rate doesn't apply to your state taxes. Treasury interest is generally exempt from state income tax, which is a nice perk if you must hold bonds in taxable. In-state municipal bonds are usually tax-free. Out-of-state usually aren't. All right, let's wire this up with an example. Imagine you want an 80-20 portfolio of 80% stocks, 20% bonds. You have $60,000 in taxable, $40,000 in Roth, and $100,000 in traditional. Step one, you would put the full 20% bond allocation into the traditional section. Use a total bond market fund or TIPS fund, whichever matches your specific plan. If that only fills 15% of your total portfolio, top up the remaining 5% with treasuries or a muni fund in taxable. Step 2, you want to fill the Roth with stock funds that you expect to grow the fastest. Your broad total market core plus any small or value tilt that you actually believe in. If you use a REIT index, Roth is an excellent home for that as well. Step 3, put the rest of your stock exposure in taxable using a total US or total international ETF. When you're rebalancing, try to do it with new contributions first. If you need to sell, do the selling inside of the tax advantage accounts to avoid realizing the gains in taxable. Some common traps that you're going to want to avoid would be chasing dividend yield inside of taxable and getting a surprise April bill, or parking REITs or high yield bond funds in taxable and suffering ordinary income taxes every year, or ignoring your specific ID and lot management in taxable, triggering wash sales across accounts when you tax loss harvest, or holding K1 or MLP products in IRAs and creating paperwork headaches, or stuffing all of your bonds in a taxable account in a high tax state when you still have free tax room available. And always remember, this is less important than actually funding your accounts. You know, which investments go in which account. The more important thing is that you are investing every single paycheck into low-cost index funds and investments that you expect to go up over a longer period of time. Where you're putting the specific investments, they matter on the margins, but we need you to be investing first. This has been Mask Money. If you enjoyed this video, hit the like button and subscribe so we can produce more videos.